Are you wanting to invest in AI, but worried that we might be in some sort of a bubble? Um, if you are, or if you've been thinking these things and not really investing in AI, then this video is for you. I'm going to go over my exact opinion on why I don't think that we're in a bubble, but at the same time, the things that I am personally looking out for, because that doesn't mean that you can just invest in any AI company and then make a whole bunch of money in the future. And before I get into any of this stuff, I just want to say that I'm not your investment advisor. This is just my personal opinion. So that being said, this is why I don't think that we're in a bubble. Let's look at the last two bubbles that we had. A lot of people think that we're in some sort of a bubble because we have all this stuff going on. The markets are at all-time highs. S&P 500 hit an all-time high just recently. NVIDIA just hit the largest valuation when it comes to company size, a $4 trillion valuation. That's basically just the amount of shares that the company has outstanding times the price of the share price was equaling $4,000. So market capitalization of $4 trillion, which is the biggest company, at least when it comes to market caps, and they're an AI company. They basically sell the picks and shovels. Here's what I mean by they sell the picks and shovels. If you think of like the gold rush, all these people were coming from all over the United States to California, Oregon area, maybe even Washington too, but I know for sure California, and they were coming here to pan for gold. And there's an old saying that says that, the people who made the most money during the gold rush are the people who are out here in California selling picks and shovels to all the people who are coming here to mine for gold. And so that's what NVIDIA is basically doing. They're selling the hardware that's necessary for companies to create their own different types of AI. So there's a lot of companies that are creating their own AI. We have Microsoft with Copilot. We obviously have OpenAI, which is a private company who created ChatGPT. Big AI sleeper that not that many people really talk about, at least not in the investing world, is Tesla. But really that's Grok AI, which is XAI. So XAI, privately held, owned by Elon Musk. They created Grok, and Grok is now integrated into Tesla's. Tesla is using this AI to be able to use their cameras in their cars for self-driving purposes, for their robo-taxis and et cetera, et cetera. We also have a lot of companies that are creating data centers, which is basically, think of like a giant server room for all these computers that make the AI possible. So companies are building businesses. It's like a whole new economy is being built off of this AI. Data centers are being built, like CoreWeave. They rent out data center space. They buy the chips or GPUs from NVIDIA. They buy the picks and shovels from NVIDIA, and then they rent them out. So CoreWeave is basically like a company. Think of like people that are selling picks and shovels during the gold rush. Well, you got this big hardware store, giant hardware store, most successful hardware store ever, selling picks and shovels right here in California. People are getting off the train. They're showing up here. They're buying their picks and shovels to go mine for gold. And then other people are showing up and like, these picks and shovels are pretty expensive and I can't afford all these picks and shovels. Well, right next to the hardware store, another company starts, which is CoreWeave. And what they do is they buy all the picks and shovels, a lot of them, from the hardware store. And then instead of selling them to the new people, they just rent them out. They're like, you could just rent it, just return it, just rent it out, go out there, mine for gold, come back, return it. And so there's this whole economy that's just being built off of this AI thing. And a lot of people are fearful because they remember 2008, the housing bubble in 2008. They remember, and I remember this too. I was in high school. I wasn't investing in anything. I remember the dot-com bubble. I was 14 years old when that was going on. I was born in 85. So in 1999, 2000, 2001, it's middle school, high school during that time. And so the same thing was happening. All these companies are showing up in the dot-com bubble. We'll start off with that. All these companies were showing up and getting this huge valuation, like, NVIDIA, $4 trillion, market capitalization. It's huge, right? So it's like, back then there was all these companies that were showing up and they were just getting billion-dollar valuations. And this is because back then there's one key distinction and difference. This is what I'm getting at between what's going on with AI right now and what happened with the dot-com bubble, and as well as what happened with the housing crisis and the Great Recession in 2008 that created the housing bubble. And this one distinction is why I don't think that we're in an AI bubble, but there are still some warnings to heed. And so we're going to get into what that distinction is, and then we'll get into the warning right after that. And so let's talk about the commonality between the dot-com bubble and housing bubble that created the Great Recession. So in the dot-com bubble, what was really going on here? So all these companies were getting started, and they were all based off the internet. They were based off of, it's like, hey, they would create a website, they would get a bunch of users and subscribers and eyeballs on a website, and the market was really good, and the market kind of went crazy, which it tends to do. And the market started evaluating companies that weren't even producing revenue. These companies weren't making money, but they were getting all this attention and all these eyeballs. And they were like, wow, you got, AskJeeves.com has like however many people, like eyeballs, like visitors to their site, basically. And then they were starting to give these sky high valuations based off of just visitors to sites. How many people are just showing up and looking at this website? I think pets.com was one that was like huge valuation based off of how many people are just visiting the site. But these companies weren't producing revenue, but they were getting huge valuations. And so when you get a huge valuation like that, what ends up happening is investors come into the company, companies go public, right? They have an initial public offering, they offer their shares, people buy their shares. And so what happens over time is like this just happened too many times where companies got sky high valuations. A lot of investors like us, retail investors, financial investors, institutional investors, were able to put money into these companies by buying shares during the public offerings. And these companies fail to produce revenue and they go bankrupt. And then all those shares go to zero. And then when all those shares go to zero and there's a lot of institutional investors that are putting money in there, well, then you get a recession. That's what happens. You get a contraction in the market. And then companies start trying to cut costs because of that. And they cut costs, they lay off people, those people get laid off. This is the domino effect of a recession, like economics 101. And so that's what happened in the dot-com bubble. What happened in the housing crisis? So in the housing crisis, basically a bunch of people were getting loans that shouldn't have been getting loans. Banks were underwriting loans that shouldn't have been given out. People were qualifying for loans to get houses that they shouldn't have been qualifying to get loans for. And a lot of these loans they weren't fixed rate mortgages. They were like variable. So it's like, hey, the interest rate on the loan was a certain number. And then after 5 years, the interest rate is subject to change. And so what happened was that happened a lot, right? And banks were loving it because they were just making money off of giving these mortgages out and then selling these mortgages as securities. And so they were just doing this over and over and over again. But people were happy too. It wasn't just banks. People were happy because they were getting houses. They were able to buy houses. And so what happened is all of those mortgages, basically the interest rates changed like in a condensed period of time. And then all of a sudden, a lot of people weren't able to make their mortgage payments. And then all these loans go into default. And so all these loans went into default, but then the market has a bunch of securities that they based off of these mortgages. So then all these securities drop down in value at the same time. And then all these institutional investors who had bought these securities are trying to offload these securities while they're going down and going down. And this created the recession, right? But here's the commonality between these two things that's not happening with AI. Dot-com bubble, fake valuation based off of, there was no efficiency, no revenue that was being created. It was based off of like eyeballs. The market went crazy and said, look how many eyeballs this website's getting. It must be worth a lot. And 2008, the market went crazy because they're like, look at all these loans that we're able to give out. But the loans were given out, they shouldn't have been given out to people. Like these people shouldn't have qualified for these loans. But they were getting marked as AAA loans. If you want to go deeper into this, a great movie on this specifically is The Big Short. If you haven't seen it, Christian Bale and a bunch of other people. It's an awesome movie, but it kind of highlights this mortgage crisis that was going on. So people were getting loans that shouldn't have been getting loans. A lot of people that they shouldn't have qualified. And so the loans went into default. Now with AI, there's a lot of companies that are creating AI, but AI is efficient. AI is reducing costs. And so there's a certain equation that makes a company make money, right? They have to make revenue, and you take the revenue that they make and you minus the expenses, and what's left is profit. And this is very general. There's a lot of different types of revenue, different types of expenses, operating expenses, and different things. But generally speaking, revenue minus all expenses equals profit. And when a company is more profitable, it becomes more valuable, intrinsically valuable. And the stock price is reflects that over time. And so what AI does is it allows companies to reduce costs. And so there's two different ways that it does this. Is you could replace human workers with AI or robotics, right? So that, it costs less over time. Maybe a robot will cost more than your payroll initially, but over time it costs less. Or, and this is the one that I really favor, because a lot of people hear that and they think, I don't like that. People are going to lose jobs. They won't be able to spend money, and then recession anyways, right? But I don't think that that's what's going to happen, at least not at first. Who knows what's going to happen in 20 years. And this is what I see, at least in the finances division, in like accounting. And that's that we're using AI to be more efficient, but not lay off workers, but to make it so that each worker is able to get more done. And the things that we're getting done are things that produce revenue. It's like, here's an example. If an accounting firm can only, based off of the amount of employees that they have, maybe it's a really small firm, they're only able to take on 10 clients at a time without hiring more people, because they just don't have the accountants to be able to manage the workload beyond that many people, that many clients. And then each accountant starts using AI to generate their reports faster, to fact check things faster, to be able to increase their productivity and efficiency. Well, now the same accounting firm is able to take on 20 clients and not have to hire any more staff. They keep the same amount of staff. They're able to take on more clients, more workload, because they're more efficient, and make more money. So this is the general premise behind why AI is not a bubble. It's actually causing more efficiency, which leads to more production. If you're able to take on more clients and have the exact same expense load, you've added more revenue without adding more expense, which means you've added to your profit, which means the company is more valuable. And so that's why I don't think AI is a bubble. But here's what I do want to warn investors about. And that's that because I don't think it's a bubble, it's obviously a trend. So there's a lot of companies that are getting started as their AI companies, where they're like, hey, we're going to provide this AI solution. They want to be the company that other companies pick to like, hey, use our AI to do this thing, or to be more productive, or to do XYZ, right? So a lot of these companies, they may not be producing revenue yet. This is what I would look out for. And there's a ton of AI companies that stock is valued at like $2 per share. Their price to earnings ratio is in the negative, which means that they're not profitable yet. And they're a brand new company. They've been around for like a year, or they just went public recently. And we have no idea like which one of these small new companies are going to win. Anybody who says that they do, like, they don't. And so when it comes to AI, me personally, I'm investing in companies that I know are investing heavily into AI, but the companies have been around for a long time. I really like Tesla. There's a lot of controversy around that stock, but the thing that I like about Tesla is they know how to produce things at scale. They've been doing that at scale. Their logistics is down. They know how to produce, manufacture, and ship goods all over the world They're great at managing their capital, knowing what to do with their money, and like everything that goes into providing a service to customers, providing a product to customers, they know how to do that already. See, that's the thing. A lot of these brand new AI companies, they may create a really good AI, but there's the whole other business side of providing that solution to customers, getting new customers, your customer satisfaction, customer support, and like ironing out all those kinks in the business side of things, and then being able to deal with competition while doing it. Just because somebody creates a good AI model doesn't mean that they're going to be successful at everything else that comes along with marketing and selling and expanding that as a business. And so that's what I would look out for is, you know, you may invest in some of those things and you may pick the right ones and they may give you a huge return because of it. But you also have a higher likelihood of investing in things or companies that go out of business because they just get put out by their competitors. And so I'm investing in things like Google, Microsoft, Meta, Tesla, Amazon Web Services, NVIDIA, of course. They're selling the shovels. They're not going anywhere. Things like that I know are going to be there for the long term so that I can still be able to grow my portfolio based off of this AI trend, but not put myself at too much risk. So I hope that's helpful for you. Let me know if you agree with me about us being in an AI bubble or if you think that it's all going down to zero shortly. I'd just love to see what you guys think. Put it down in the comments. See you in the next one.